So here's the first example of a consolidated statement of financial position for you to work through. You'll also find a copy of the question as a PDF file along with this video. So I suggest you print that out and have a go at working through the question whilst you watch and pause the video. Now, before I start looking at the question, I just want to have a quick word about the statement of financial position layout, because there are two different layouts that you're likely to encounter both in exam questions and also in real-world examples. Both are acceptable under IAS 1, and it's just a question of emphasis, really. In the first case, we'll have a total for non-current assets and a total for current assets, giving us a total asset figure. And then we'll have the equity section followed by current liabilities, non-current liabilities, and a total liabilities figure. The equity and liabilities are then added together to give a total equity and liabilities figure. So in this particular layout, if we think back to the accounting equation, that's what we've got. We've got the assets total equaling the equity plus the liabilities, and that's a layout that you'll probably come across in the exam. The other option, and it's the one that I've used working through this example, we've got the non-current assets, current assets, total assets, but then we've got current liabilities, non-current liabilities, and total liabilities taken away to give us a net asset figure, and that then agrees with the total equity. So this second layout is more like the sole trader accounts that you might remember from level 3, where you've got a net asset figure equaling the capital account on the opposite side of the balance sheet. So in this case, thinking about the accounting equation, we've got assets minus liabilities equals capital, or in this case equity. So either layout is acceptable. In the exam, it will probably be the first of these two that you'll come across, but if you look carefully, you'll see that the totals are exactly the same. There's a total for current and non-current assets, there's a total for current and non-current liabilities, and there's a total for equity. So as long as those totals are readily viewable, then IAS 1 doesn't really mind how they're laid out on the screen. So here's the first worked example that we'll have a look at. There we've got two statements of financial position, the balance sheet of P Limited, that's the parent company, and S Limited, that's the subsidiary. Just make sure when you're looking at questions like this that you make a note of which way around those two companies' results are presented to you. Sometimes the parent company's figures will be on the left column, sometimes they'll be on the right, so it's important to just make sure that you don't confuse those. So there are the individual balance sheets, and we're given some additional information. The parent company acquired 80% of the subsidiary for a price of £275,000, and on the date that we acquired those shares, the subsidiary company S Limited had already got retained earnings of £48,000, and we're also told that at that date some of the property, plant and equipment included in the balance sheet at £80,000 was actually worth £123,000, and that higher figure would have been taken into consideration when working out how much P Limited would have to pay for the shares. And then finally we're told that at the year end there's an intercompany balance. S Limited owed £12,000 to P Limited. So in P Limited's statement, the trade and other receivables figure of 80,000 will include £12,000 owed by S Limited, and in S Limited's trade and other payables figure of 95,000, that £12,000 will also be included. Now, in a question like this, the most important thing to do first, more than anything else, is to calculate the goodwill. That's the most complicated calculation. It's where a lot of the marks will be earned in the exam, and in more recent examinations, it's the one thing that you've sometimes been asked to do rather than complete the entire balance sheet statement. So to calculate the goodwill, we first of all need to work out what the net asset value in S Limited's balance sheet would have been at the date of acquisition of the shares when we bought our 80%. And remember, the net asset figure will be the same as the equity total, and so it's the equity total that it's easy to calculate. So we take the share capital and we assume that there have been no changes to the subsidiary's share capital since the date of purchase. That would normally be included in the information given to you. So we take the subsidiary's share capital figure, and then we add to that the retained earnings as they were at the date of buying the shares. Don't make the mistake of including the current retained earnings figure of 86,000. It's the £48,000 that we need to include that will be included in the notes to the question. That gives us a figure of £188,000. That's what the balance sheet total would have been of S Limited at the date we became an 80% shareholder. But that doesn't reflect how much S Limited was actually worth at that date, because some of the assets were worth more than their book value, and so we have to make a fair value adjustment to take account of the difference between market value and book value of those assets, and that comes to £43,000. The assets were worth 123,000. They're in the balance sheet at 80,000, so we need to add £43,000 on to take account of that increased value. That gives us a market value for the whole of the subsidiary at the date of buying our 80% of £231,000. We haven't purchased the whole of the company, we've only purchased 80%, and so we're only entitled to 80% of that value. So what we must now do is deduct from the total value of the company the bit of that value that belongs to somebody else. That's the minority interest in the business, which is the 20%. That leaves us with a figure of £184,800. That's our 80% share of the company. That's how much it was worth at the date of acquisition. But that's not what we paid for our 80%. We actually paid £275,000. And the difference between that, the difference between the value of the assets acquired and the price paid, is the goodwill figure. And remember, that's the definition in IFRS 3 of goodwill, the difference between the value of assets acquired and the price paid. So £90,200 is the figure for goodwill, and so we can insert that now into the consolidated statement of financial position. If we now work through the other items, starting with the property, plant and equipment, we've already calculated as part of the goodwill calculation that there is a fair value adjustment required to reflect the market value of the assets of the subsidiary at the date we purchased the shares, and so we know that that £43,000 has got to be added to the existing balance sheet figures. In the consolidated balance sheet, we want to reflect the cost of the subsidiary's assets to the group rather than the original cost to S Limited, and that requires the addition of that £43,000 fair value adjustment. So that will give us a total figure for property, plant and equipment, 613,000. There are some intangible fixed assets, maybe leases or something similar in both companies. Those can just get added together. The investment figure, remember, we need to eliminate the investment that P Limited made in S Limited, and that's the £275,000. So that needs to be eliminated. We've still got a small investment that S Limited has made, and that remains in the consolidated statement, giving us a non-current asset total of 732,200. If we then move on to current assets, the stock, there's no note in the question here regarding unrealized profits within stock, and so we can simply add those two figures together. Trade and other receivables requires an adjustment. If you remember, the question tells us that there was a £12,000 intercompany balance at the end of the year, so we need to eliminate that from the trade receivables figure. It wouldn't be there if we were dealing with just one company. That leaves trade and other receivables of 156. The cash figures can be added together, so we've now got our current asset total and our total asset figure of £1,005,200. Current liabilities are fairly straightforward. The only adjustment we've got to make is to eliminate the intercompany balance again from the trade payables figure. That leaves us with £160,000. Tax figures just get added together, and that gives us our consolidated current liabilities total. The bank loans, there are no intercompany loans included in those figures, so they will just get added together. That gives us our total liabilities figure, and if we deduct that from our total assets, then we've got our net asset figure, and that's the top half of the balance sheet complete without too much of a problem. If we now look at the equity section, the share capital, we could have put that in right at the very start, because remember, the only share capital, the only share premium account that appears in the consolidated statement of financial position is the parent company's, P Limited's, and so we can simply insert that share capital figure of 350,000. The last two figures are the retained earnings and non-controlling interest figures, and very often in exams recently, those are the figures that you've been asked to calculate rather than complete the entire statement of financial position. So if we look first of all at the retained earnings figure, excuse me, we'll take first of all the parent company's retained earnings, the current figure of 268,000. We then need to add on to that the group's share of profits that the subsidiary company has made since the date we became a shareholder. And we can calculate what those post-acquisition profits are by taking the current earnings figure from the subsidiary company statement of 86,000. And if we deduct from that the retained earnings that were already there when we became an 80% owner of the business. That's given to us in the question. That's the 48,000. The difference between those two must be the retained profits that S Limited has generated since the date we acquired 80%. So those are the post-acquisition profits. Now, we're not 100% shareholder, so we don't have the right to all of those profits. Some of them belong to the minority shareholders, and so we have to deduct their share. That leaves us with our group share of post-acquisition profits equal to £30,400. That figure, the group's share of post-acquisition profits, gets added to the parent company's retained earnings figure to give us a total consolidated retained earnings of £298,400. Now, if there was any adjustment to the stock value, that might need to be deducted from this figure. If there was any goodwill impairment and we were reducing the value of goodwill, then that might also need to be deducted from the retained earnings figure. But neither of those adjustments are necessary in this example, so we've got retained earnings of 298,400, and we can put that into our consolidated statement. The final thing we've got to calculate is the value of the non-controlling interest. And in past exams, if you were pushed for time and you were fairly confident about the other figures, then clearly you could calculate that non-controlling interest figure as a balancing figure, because we know that the total equity's got to equal the net assets of 702,200. And it's maybe because of that tendency to just put in a balancing figure that AAT are now tending to ask for calculations of individual figures from the consolidated statement rather than the preparation of the whole thing. So to account the non-controlling interest, we need to include two things. We need to include the minorities' share of the company at the date we acquired our 80%, and we've already calculated that. If we look back at our goodwill calculation, we'll see that we've got a non-controlling interest figure there that we've deducted of 46,200. So that's the first thing that we can include in this account, is the non-controlling interest's share of the subsidiary's value at the date of acquisition. And we've then got to add on to that the subsidiary's share of post-acquisition profits. And we've already calculated that when we came to work out the group's share, and that's the 7,600 that we deducted when calculating the consolidated retained earnings. So we've already calculated both of those figures. And so we've now got the non-controlling interest, the minority share of the subsidiary at the date we became a shareholder, plus the minority share of profits made since that point in time. And that gives us a non-controlling interest total of 53,800. But again, remember, if there's an adjustment to the stock value to adjust for unrealized profits, if those profits were originally made in the subsidiary, then part of the adjustment would be deducted from this £53,800 figure. But there's no adjustment needed for that in this case, so we can put that final figure into the consolidated statement, and that gives us our total equity figure of 702,200. So that's a work through of the entire balance sheet from top to bottom. The only other adjustments that you're likely to encounter in the exam are impairment of goodwill, and remember in that case we reduce the goodwill figure in the non-current assets section, and the same adjustment is made to reduce the retained earnings figure in the equity section. Apart from that, the only other adjustment might be to the closing inventory figure, the stock figure, if there's any unrealized profits, and you'll remember we dealt with that as part of the consolidated profit and loss account. So that's the first example work through of a complete statement of financial position.